Hey, what's up, guys? Today, I'm excited to bring you guys one of the coolest option strategies that I've learned over the last couple of years, known as the credit spread. Whether that's the put credit spread or the call credit spread, I think it's a wonderful way to scale your portfolio, make outsized returns, to build your account faster. And honestly, this is the fastest way, in my opinion, to double your portfolio. The thing is, with this option strategy, it's a bit risky, but I'm going to go into it today to hopefully prepare you guys and show you guys how I run the strategy and how maybe you guys can run it too. Now, just a disclaimer here. Again, I am not a financial advisor. None of what I'm about to show you is financial advice, but if you do your research and you understand some of the terms that we've talked about here, this is a wonderful strategy for you to embark onto or into to scale your portfolio. So if you guys haven't already, go to my playlist and check out my options playlist, or just scroll through my video log and check out my 2 videos, covered calls for beginners and cash secured puts for beginners. And this will help you conceptually understand what a call is and what a put is and how you can utilize that terminology and those strategies here with the credit spread. Later, I will do a video for the debit spread, which is even more risky than what I'm about to show you here. But with these spreads, you can, like I said, scale your portfolio and, double your money in a very short period of time. As you guys have noticed, when I started this portfolio back in late April and started filming videos, I had about $7,900, and now here we are at almost $11,000. I do small contributions every single week, but I am relying on my options premiums as well as dividends and interest from my excess cash to further scale the portfolio. Without further ado, let's get into it. So this morning, I went ahead and opened up the SoFi put here at the 950. I got a $45 credit, which is actually pretty good. And, SoFi is at 974, so this is fantastic. I think when I sold this one for a $45 credit, it was hovering at about $9.34. Here is, a Tesla put credit spread, which I had opened up last week for expiration on 7/21. I opened it for a $37 credit, and it's sitting at $21 right now. Tesla has been on a run. I don't believe it's going to be at the 255 or the 252 anytime soon. So this one will likely expire way out of the money, and I will be fine. They will both expire worthless. I'll collect my premium and run off into the sunset. So oftentimes with the credit spread, basically what you're going to do is it's a leveraged position where you can either utilize margin, which I do not recommend at all, or you can utilize excess cash in your account to use as collateral to put up the trade. Now, that's what I'm doing here in Robinhood. Specifically, you will need level 3 options trading, which is going to be the advanced options trading, level in order to execute on this type of trade. So first, I'm going to go into the put credit spread because I have one here opened up on Tesla. So with a put credit spread, how I utilize it is, the idea is that whatever the stock is trading at, you don't think that the stock will go lower than that particular strike price. In this particular scenario, I opened up a Tesla put credit spread at the 255, 252.50 spread, which if you notice the difference between the 255 and the 252.50 is $250, which is essentially the collateral that I have up for this particular option, right? Excuse me. So if I open this up here, you're going to notice, I think it'll show my collateral somewhere here. It does not actually. Anyways, yeah, actually I need to view my Tesla positions. That's what it is. So if you notice here, I have collateral, $250. In order to open up this trade, today I'm up, total of $16 or 40%. So if you think about it, basically what you have to think about here is whenever you're executing on the spread strategy, which I like to do on multiple different stocks, I like to target anywhere from a 3 to 12% return on my initial collateral. So just to dumb it down for you guys, essentially what I'm talking about here is in this particular case, my collateral is $250. So pretend that the strike price was $255 and $254. That would be $100 of collateral. So essentially in this particular case, which wouldn't be the case, but if I made $37 on $100 collateral, that is a 37% return on the money that I am putting up for stake, right? So again, what I do is for this particular strategy, I looked at Tesla's charts and I was looking over the last 3 months. If you notice, they are on an absolute terror. They just keep going up and up and up. And specifically since the beginning of June, they're up about $79 or 38%, right? So you guys have heard me talk about the Bollinger Band in a couple of my last videos, especially the options trading videos. And that is just a technical analysis that basically is saying that the stock price should trade between two particular prices within two standard deviations. Basically, statistically, it should stay within that band. So what I do is I utilize the Bollinger Band to understand where I want to execute on my strike prices, right? So in Tesla particularly, I don't have the bands up in front of me, but whenever I made the decision, I figured that 255 was an appropriate rate because if you think about it, the last time we were at 255 was basically in June 14th, right? And then it dipped for a little bit. It went all the way down to 41, but we've since been on a tear here, okay? So the reason why I chose that price, one, it was an attractive premium, but then two, the technical analysis has told me that the 255 strike, in theory, should be safe statistically. And again, that goes back to probability. So here, basically what I would do now is if you look at this, if you look at the Tesla chart, in the last week, we're up about $13, which, 5% move in Tesla is not uncommon. So just be careful when you're trading these highly volatile stocks, especially with spreads, because the downside to spreads are you could literally lose your entire collateral. So the danger is that you don't select a good strike price and it either exceeds that strike price and then basically your entire collateral is going to be eaten up, right? And when we go into setting up a trade, which I will likely do a call credit spread to show you guys, I will kind of go more in depth with those details. So basically what you're going to want to do is you want to hit trade options, and then select whatever, expiration date that you want to, right? And in this particular case, I have a Tesla put credit spread here. If you notice the 255 right here, and then the 250 right here, right? So I bought one and I sold one. So that's why they call it a spread, is because you are buying and selling the same option, essentially, like the same, not the same chain, but the same, strategy, either call or either put, and then you're protecting your downside risk. Meaning, even though I would get put the stock at 255, I could also put the stock at someone else at 250, basically saying that the only money I would lose is the gap between the strike prices, which would be $250. So let's go into, Tesla here. So basically, as an example of selling a put credit spread, I would first sell the option that I don't think that it would go to. So let's just say that I'm going to say that Tesla isn't going to go below 265 on July 21st. So I would sell the 265 put, then I would buy the leg underneath it, which would be the 262.50, which would be a $250 collateral. And when I open up this option, now you'll notice here, right? So basically what I did here was let me close this down. I sold the 265 put, meaning someone can put me the shares at $265. Then I bought the 262.50 put, meaning I can put someone the shares at $262.50, no matter the price. And then the difference between the two is, if you notice, I'm going to get a credit of $46, right? And how that is possible is because if you notice, I am selling a option that will give me $2.66, and then I am buying one that I'm paying $2.22. So the difference is going to be this credit right here, right? So if you notice on the trade here, if it goes all the way down to 265, essentially I will collect the entirety of my premium, which is $46 credit here in this case. Sorry, my fingers are a little bit wiggly here. But if it goes below that, the max loss I can do, excuse me, is essentially the difference between my collateral and the amount of credit I get, right? So I'm putting up $250 in collateral, but since I'm getting a $46 credit in this case, the only amount of money I can lose is the $204 difference. Okay? So actually, I kind of like this trade right here. So what I'm going to actually do is I'm going to go ahead and sell this. So going back into it just from scratch, in order to sell the put credit spread, I do not think that Tesla is going to dip below the 265 before the end of business on July 21st. So I'm going to sell the put at 265. I'm going to buy the leg under it. I'm going to open the trade. It's a $45 credit. And if you notice the bid ask, again, you're going to sell closer to the bid because here we're at the top of the bid ask spread. And if you notice here, it says low fill likelihood. Now it's medium because the option is constantly moving. In order to secure the option easily, I like to sell right pretty much close to the bid, which is a medium likelihood. And let's swipe up and let's see if it takes for us. So it might be too risky because see, it's like, if you notice here, the bid ask is moving. I might have been a little bit too aggressive. Yep. All right. So let's just go back into it real quick. And I'm going to sell it right at the bid. Swipe up. Boom. There you go. So now I got a $46 credit. And if you go back to my main account, I sold another put credit spread at a 265, 262.50 spread for $46 credit with a $200 collateral, which now it's going to show $500 because I have two put credit spreads out, one between 255, 252.50, and one between 265 and 262.50. So that was a bit quick, guys, but basically if you think about it, I don't have a calculator in front of me, but $46, so let's just round it up to 50, divided by 250 is essentially a 20% return on my money. Or is that right? Because $50 can go into 250 5 times. 5 goes into 120. Yep. So I have a 20% return. If this option ends up expiring way out of the money, which sometimes what you want to do is you want to manage your position and you want to end up closing the position if it starts to get closer to your strike prices, or if it just goes absolutely crazy and you want to go ahead and capture your profits. So I can buy back this at any point in time. That would be kind of a topic for a later video, showing you guys how to either roll this strategy or close the strategy out. Hopefully that wasn't too confusing. Let me know any questions you have down in the comments and I'll definitely try my best to answer them. And I'll probably try and do another spread video going a little bit more in depth and a little bit more slowly, but I am on my lunch break right now, so I need to get back to work here in the next 15 minutes. So I appreciate you guys. Go ahead and smash that like button. Comment if you haven't already. Any kind of questions you have down below. Subscribe if you already haven't. Go check out my other options videos within my options playlist to get a better idea of what a call is and what a put is. And if you're still here in this part of the video, comment YouTube, because we're on YouTube. You're watching. I'm putting up some content. I'm also watching. Love you guys. See you guys next time. On Friday, I will post another video with a recap of this week, maybe closing out these options or maybe showing you guys that this option strategy has played out perfectly.